But myself working as a master of business administration, Mr. Kumar Institute of Technology. In this video, we are going to see the part three basic decision capital structure. Subject was MB25201 regulations under 2025. Having understood leverage MBA EPS analysis, now turn to the big picture. What capital structure is and what factors influence. We will cover the meaning of capital structure, features of an appropriate capital structure, determinants of capital structure, important consideration in planning capital structure. Let's begin. Meaning of capital structure. Capital structure refers to the proportion of debt to stock and common stock on a company's balance sheet. More precisely, it represents the proportionate relationship between debt and equity. Equity includes paid up share capital, share premium, resource surplus, which means retained earnings. Capital structure is a strategic choice that affects both risk and return. It's not just about how to step versus equity, it's about finding the right mix for the company's specific situation. Next, we'll see about the features of an appropriate capital structure. What makes a capital structure? appropriate? There are several features. First, we will see the optimal capital structure, the mix where market value per share is maximum and total cost is minimum. Second, profitability return should maximize returns to shareholders, which means EPS earning per share and market price. Third, solvency or risk should not expose the firm to excessive insolvency risk. The fourth, flexibility should allow operation without much cost or delay. Fifth, conservation of capacity should match the firm's ability to generate profit to pay interest and principal. Sixth one, control should avoid unnecessary dilution of management control. A good capital structure balances these sometimes competing objectives. Then we will see about the determining of capital structure. Major factors influence capital structure decisions are seasonal variation, the tax benefit of debt, flexibility control, industry leverage ratio, agency cost, industry life cycle, degree of completion, company characteristics, requirement of investors, timing of competition, legal requirements. First, we see about the seasonal variation. It is a need for temporary financing, then tax benefit of the interest is tax deductible. This means the interest will be deducted tax. While calculating the tax, interest will not be taken as a considered. The third, flexibility is an ability to raise funds as needed. Then fourth, control preference for debt over equity to avoid dilution. Then industry leverage ratio, it benchmarks the firm from the competitors. Then agency cost, cost of monitoring and aligning trust. Then industry life cycle, growth stage affects financial needs. Then degree of competition, it shows the stability of earnings. Then company characteristics, it gives the size, profitability, asset structure of the whole company. Then requirement of investors, what investors prefer will be in this capital structure. Then timing of public issue, it's market conditions, the legal requirements, it's a regulatory concerns. These factors must be considered together. Then see the factors affecting capital structure, internal and external. Both was divided in internal. There is a financial leverage, risk, growth and stability, retail control, cost of capital, cash flows, flexibility, purpose of finance, asset structure. Then in external, size of the company, nature of the industry, cost of innovation, legal requirement, meaning of finance, level of interest rate, level of business activity, then availability of funds, taxation policy, level of stock price, then final condition of the capital market. These are the major factors affecting capital structure. That factors have been split into internal and external. Internally, what are all the factors affecting the capital structure of the firm shown here? And externally, which means outside the company, what are all the factors affecting capital structure have been mentioned here. Then planning the capital structure is an important consideration. When planning capital structure, six key considerations stand out. First, return, second, cost, third, risk control, fifth, flexible, and sixth, capacity. Return. It's an ability to generate maximum return to shareholders, which maximizes EPS and market value or market price of the shares. Then cost, it minimizes the weighted average cost of capital, where the debt is cheaper due to tax shield on interest. Then risk, insolvency risk increases with high component. Then fourth, control, avoid dilution of company or management control. Debt preferred to new equity shares. Flexible structure should allow alteration without much cost or delay. Which means the capital structure can be easy to do some alterations so that it will be flexible. Means we can't spend, cannot spend more cost or it cannot be delayed while framing the new capital frame structure. So the capital structure framing should be flexible to be changed depends upon the future's consideration, future business like then capacity. It's an ability to generate profits to pay interest and principal. These considerations form the foundation of capital structure plan. And that's a wrap up of part three of unit three. We have defined capital structure, identified features of an appropriate structure, and explored many practices that increase importance. We will dive into the concept of optimal capital structure and the major theories that explain the relationship between capital structure and the flow. If you found this video helpful, please like, share, and subscribe to the YouTube channel so that you can get the more content related to your studies. If you have any questions, please leave your questions in the comment. Thank you for watching. See you in the next one. Thank you.